Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. DFI Retail Group, trading under the ticker DFIDF on the Singapore Exchange, has made a significant business move that's reshaping its Singapore presence. On Monday, DFI announced it's selling its entire Singapore food business to MacroValue, a major Southeast Asian retail conglomerate based in Malaysia. The deal is worth $125 million, though that figure may change with adjustments before closing. Let's break down what's included in this sale. DFI is divesting Cold Storage Singapore, which encompasses 48 cold storage supermarkets and 41 giant stores across the island, plus 2 distribution centers that support these operations. If you've lived in Singapore for any time, you've definitely shopped at one of these stores. They're fixtures in neighborhoods across the country. This is a strategic pivot for DFI, which plans to refocus its Singapore operations on its Guardian pharmacy chain and 7-Eleven convenience store businesses. The transaction isn't happening immediately. It's expected to complete in the second half of 2025, giving both companies time to manage the transition. The market responded positively to this news. DFI shares closed 4% higher on Monday at $234, gaining $0.09 per share. This suggests investors view the divestment as a smart strategic move that will allow DFI to concentrate on potentially more profitable segments of its retail portfolio. Looking at the broader context, this deal reflects ongoing consolidation in Singapore's competitive grocery retail sector. For shoppers wondering what this means, cold storage and giant stores will continue operating, just under new ownership once the deal closes. The change might eventually lead to different product selections or store layouts as MacroValue implements its own retail strategies. From a technical perspective, DFI stock has been showing strength recently. This positive price movement following the announcement could signal the beginning of a new uptrend if the momentum continues. Trading volume was notably higher than average on Monday, indicating strong investor interest in this strategic shift. Fraser's Centrepoint Trust, FCT, one of Singapore's leading retail-focused REITs trading under the ticker J69U, has announced a major property acquisition that will significantly expand its portfolio. On Tuesday, FCT's manager revealed it has entered into agreements to acquire the south wing of Northpoint City in Yishun for $17 billion. For those unfamiliar with Northpoint City, it's one of the largest integrated developments in northern Singapore, serving as a major retail and community hub in Yishun. The South Wing complements FCT's existing ownership of Northpoint City North Wing, potentially creating operational synergies and strengthening FCT's presence in this growing residential area. To finance this substantial acquisition, FCT is launching a multi-pronged funding approach. The trust announced a private placement to raise approximately $200 million and a preferential offering to existing unit holders for another $200 million. Additionally, FCT plans to use debt financing and may issue subordinated perpetual securities worth about $200 million to complete the funding package. This acquisition represents a significant growth move for FCT, expanding its footprint in suburban retail, a segment that has proven resilient even during economic downturns. Suburban malls like Northpoint City typically benefit from steady footfall from nearby residents and are less dependent on tourist traffic compared to downtown retail properties. FCT units closed at $2.21 on Monday, up 0.5% or $0.01 before the announcement. The trust requested a trading halt on Tuesday morning ahead of this major announcement, which is standard practice for significant transactions of this nature. From a technical analysis perspective, FCT has been trading in a relatively stable range recently. This acquisition could serve as a catalyst for price movement once trading resumes, depending on how investors assess the value of this addition to FCT's portfolio and the impact of the equity fundraising on existing unit holders. ESR Real Estate Investment Trust, trading under the ticker J91U has completed a strategic divestment of a logistics property in Singapore. The trust manager announced the sale of the property located at 1/3 Lok Yang Road and 4/4 Lok Yang Road in the Pioneer Industrial Area for $6.8 million. This sale price represents a 3.5% premium above the property's valuation of $6.6 million as assessed at the end of 2024, suggesting the trust was able to extract good value from this asset. The divested property has a 30-year lease term that's set to expire in December 2031, meaning it had less than 7 years of leasehold remaining. For context, ESR REIT focuses on industrial, logistics, and business park properties across Singapore. This divestment aligns with the trust's ongoing portfolio optimization strategy, where they periodically review and refresh their property holdings to maximize returns for unit holders. The proceeds from this sale will be put to work in several ways. The trust plans to use the funds to reduce outstanding debt, finance potential new acquisitions, fund asset enhancement initiatives and redevelopments, and support general working capital needs. This balanced approach to capital allocation demonstrates the management's focus on both strengthening the balance sheet and pursuing growth opportunities. ESR REIT units closed at 245 on Monday, down 2% or $5 before this announcement. The slight decline might reflect broader market conditions rather than anticipation of this relatively small divestment, which represents only a fraction of the trust's overall portfolio value. From a technical analysis standpoint, ESR REIT has been trading in a relatively tight range recently. The trust's unit price performance will likely be more influenced by broader interest rate trends and industrial property market conditions than by this single divestment. GuocoLand, a major Singapore-listed property developer trading under the ticker F17, has announced a key leadership change for its China operations. Kevin Zhou has been appointed as the new managing director of GuocoLand China, the company's wholly owned subsidiary that manages its mainland China business. Zhou takes over from Peter Lee, who has held the position since April 2022. This leadership transition became effective immediately upon announcement. Zhou brings valuable experience to GuocoLand, having previously served as Keppel's executive vice president of business development in the real estate division. His background with another major Singapore property player should provide him with relevant expertise for this role. In his new position, Zhou will oversee GuocoLand's entire business in China, including both development projects and investment assets. This is a significant responsibility as China represents an important market for GuocoLand's international growth strategy. GuocoLand, for those less familiar with the company, is a premier property developer with a diverse portfolio spanning residential, commercial, and mixed-use developments. Beyond Singapore and China, the company also has operations in Malaysia and Vietnam. Some of its notable Singapore projects include Guoco Tower, Midtown Modern, and Meyer Mansion. Shares of GuocoLand closed at $1.47 on Monday, down 0.7% or still 1 month before this leadership announcement was made public. This minor price movement likely reflects normal market fluctuations rather than anticipation of the management change. From a technical analysis perspective, GuocoLand's stock has been relatively stable recently. Leadership changes typically don't cause immediate significant price movements unless they signal broader strategic shifts. Investors will likely be watching for any changes in GuocoLand's China strategy under Zhou's leadership before adjusting their positions. As we look toward the rest of the week, several factors could influence the Singapore market. Global developments, particularly U.S. economic data and Federal Reserve commentary, will likely have spillover effects on local sentiment. For specific companies we've discussed today, watch for further details on FCT's equity fundraising for its Northpoint City acquisition. The market's reception to the private placement and preferential offering will provide insights into investor appetite for retail mall assets in the current environment. DFI Retail Group may provide additional information about its plans for the Guardian and 7-Eleven businesses now that it's focusing resources on these segments. Any strategic initiatives or expansion plans could further influence the stock's performance. For ESR REIT, investors should watch for announcements about how the trust plans to deploy the proceeds from its recent divestment. New acquisitions or asset enhancement initiatives could provide catalysts for unit price movement. GuocoLand's new China leadership will be worth monitoring for any shifts in strategy or new project announcements in that market. Given the challenges in China's property sector, Joe's approach to navigating this environment will be crucial. That's all for today's Singapore Market Digest. I'm Iggy from the Investing Iguana, reminding you that while we provide market analysis, always do your own research before making investment decisions. See you in the next update.